It's funny. In most parts of life, a price tag is pretty straightforward. Shirt says $20, it costs $20.
Mm-hmm.
But in finance, the number printed on the tag is almost never what you actually end up with.
It's a total optical illusion, you're right. Today, we're doing a deep dive into investment returns, pulling from the SIE Chapter 6 material.
And the mission here seems pretty clear.
Yeah, it is. We really need to decode what an investment actually earns, to stop just looking at the sticker price, that coupon rate, and see the real math behind it.
Because if you don't, you could be walking straight into a math trap thinking you're getting a safe 5% when you're front. You're really not.
Right. And there's no better place to see that trap than the bond market. The source material uses this fantastic visualization, the teeter-totter.
I love this one. It explains that inverse relationship that I think a lot of people struggle with. You got interest rates on one side of the seesaw.
And bond prices on the other.
So when market rates go up,
the price of your existing bond has to go down. And vice versa. But, and this is the critical part, the center of that teeter-totter, it never moves.
the fulcrum, that's the nominal yield, right?
That's it, exactly. The nominal yield is just that coupon rate printed on the certificate. If it says it pays you $50 a year, it pays you $50 a year. Full stop.
Doesn't matter what the market is doing.
Nope. But because the price you pay for that bond can change, the whole return calculation gets warped.
Okay, so let's say I buy a bond on sale, a discount bond. I pay, what, $800 for a $1,000 face value? I'm still getting that same $50 check.
Exactly. Which means your current yield, the interest divided by what you actually paid, is suddenly higher than the coupon rate. You paid less to get the same income.
But wait, that's not even the best part of the deal. The real juice is the yield to maturity. Because when that bond matures,
You get the full $1,000 back.
so I just made a $200 profit on top of all the interest payments.
And that is why, for a discount bond, the yield to maturity is always the highest number. It's the income plus that built-in capital gain.
Which is the total opposite of buying at a premium, like paying $1,100, where you're guaranteed to take a small loss at maturity. The whole seesaw just flips.
And that's where people can get burned. They see a high coupon, they overpay for it, and they completely ignore that they're going to lose principal at the end.
The data does mention a kind of safety net, though. Yield to worst. It sounds ominous, but it's really just for callable bonds, isn't it?
It is. I mean, if you buy a bond at a premium, the issuer might want to call it back early, basically to refinance their debt at a lower rate.
And if they do, you lose that premium you paid way faster than you expected.
Right. So the rule is you have to quote the yield to worst. The lower of the yield to maturity or the yield to call. It's a worst case scenario number, so you're not surprised.
Smart. Okay, so let's shift gears a little to stocks because this what you actually keep problem is there too, just in a different way. It's not just about dividends.
No, not at all. It's about total return.
Yeah.
Growth plus income. You have to combine the stock price movement and any dividends you received.
And then, of course, Uncle Sam gets involved. I was looking at the tax breakdown in the sources, and the difference between holding a stock for 365 days versus 366. It's massive.
It is huge. Short-term gains, that's anything held a year or less, are taxed just like your salary.
Which for some people could be, what, 37%?
It could, but if you just wait one more day, it becomes a long-term capital gain.
And that rate drops to a maximum of 20%.
For most people, it's even less. It's basically a reward from the government for being a patient, long-term investor.
And there's even a silver lining if you lose money, right? The netting rules.
Yeah, you can use your losses to cancel out your gains for tax purposes. And if you have a really bad year where losses are more than gains, you can use up to $3,000 of that excess loss to lower your regular taxable income.
But the most surprising tax rule in here, for me at least, has to be the stepped-up basis. This almost feels like a loophole for heirs.
It's probably the biggest estate planning tool there is. When you inherit stock, the IRS basically resets the cost. They don't care what the original owner paid.
They only care about the value on the day that person died.
That's the new cost basis. So if your dad bought Apple in the 80s for pennies, and it's worth millions when you get it,
all of those capital gains taxes just disappear.
Oof, gone. Your new cost is the market value on the day you inherited it. If you sold it the next day, you'd owe zero tax.
That is just wild.
Yeah.
Okay, so whether we're talking bond math or tax math, the headline number is almost never the real story.
That is the big takeaway. Don't just look at the coupon. Don't just look at the stock price. You have to factor in everything: the price you paid, the maturity, the taxes, the holding period.
And there's one last invisible factor the sources mentioned that can eat away at your returns. Inflation.
The real interest rate.
Yeah. It's kind of a sobering thought to end on, isn't it? If your portfolio goes up 6% in a year, but inflation is running at 2%.
You didn't really make 6%. In terms of what you can actually buy, you only made 4%. That's your real return.
So, the question to leave everyone with is, next time you check your account balance, ask yourself, what is this money actually worth in the real world today?